Welcome to our regular video series. This week, we will be focusing on the housing market. In neighbourhoods across the country, Saturdays have been lacking a very Australian event, public auctions. This is soon to change for some states like New South Wales. However, even for sale signs have somewhat gone into hibernation as more sellers hold off to see how COVID-19 and the related restrictions across the economy unfold. Since the outbreak of COVID-19 has escalated and the bans come into force, auction numbers and clearance auction rates have fallen dramatically. It reflects a drop in housing turnover. This, along with the broader uncertainties relating to COVID-19, is resulting in rising discussion about where dwelling prices end up when we get through this. If we use history as a guide, dwelling prices registered annual declines in past downturns. But they've actually been pretty small. Indeed, when Australia last experienced a recession in 1991, combined capital city prices eased on average just 0.3% in 1991. And in the global financial crisis in 2008 and 2009, average median dwelling prices across the capital cities actually rose on an annual basis. Why? One reason is that in downturns, the withdrawal of sellers usually helps prevent sharper falls in prices, which may yet occur again. During the GFC, there was also still a shortage of dwellings and interest rates fell. However, I'd caution placing too much emphasis on past experiences, given the COVID-19 recession is very different to prior downturns. It's also widely expected to be much deeper than during the GFC. The RBA, for one, expects national economic output to fall by 10% over the first half of this year, which would be the biggest contraction since the 1930s. It's playing out fast. According to new, more timely data from the Australian Bureau of Statistics, employment fell by 6% from March 14 to April 4. If this rate of decline in employment were to manifest in the regular labour force survey, which is conducted monthly, it would suggest a very sizable decline in jobs in April. We expect the unemployment rate to lift to 9% this quarter, with a rise to the double digits not to be ruled out. Of course, the federal government's JobKeeper wage subsidy will go some way to cushioning the impact. However, incomes are still set to fall significantly. One truism over time is that weaker economic growth and higher unemployment reduces housing demand, even when interest rates are low like they are now. Moreover, heightened uncertainty about the economic outlook is likely to cause households and investors to hold back on big decisions, like purchasing a home. Another issue for the housing market is lower migration from overseas. Australia's strong population growth has helped underpin housing demand for many years, but it's mostly driven by net overseas migration. With borders closed, inbound migration will fall significantly in the near term, and the amount of bounce back once the health crisis passes remains uncertain given the sharp projected rise in unemployment. More positively, mortgage rates are very low and banks are providing mortgage holidays for up to 6 months. This is likely to help reduce forced selling in the near term. Furthermore, sellers in healthier financial situations may wait for a better time to sell, reducing the housing stock available for sale and thus potentially limiting the extent of price declines. Data out just last week showed dwelling prices continued to grow in most capital cities in April. This was a surprising result and suggests some of the biggest falls feared in dwelling prices this year may not transpire. Thank you.